Welcome to Secure Money Mindset, the ultimate podcast for financial planning tips and strategies. Our episodes are designed to be concise and to the point, lasting no more than 30 minutes. Each episode features seasoned advisors from Secure Planning Group or an outside financial specialist discussing crucial issues and providing actions to consider when addressing your top financial concerns. We value honesty and transparency, meaning we present both the good and the bad news in a clear and concise manner. Our goal is to provide you with reliable insights and practical guidance. Be sure to hit the follow button to stay up to date with our latest episodes. For more information, please visit our website at securepg.net. Let's dive into this week's episode of Secure Money Mindset.
Hey, everybody, and thanks again for joining us. It's Mike Lenge with the Secure Money Mindset podcast. With us today, we have Josh Rogers of Invesco. He's a client portfolio manager on their equity team. And we're here to talk to you about direct indexing as a whole, but drill into a couple of the unique strategies that are offered through Invesco. But really wanted to take this opportunity to have a true expert educate us on the concept of direct indexing and how it really can drive better outcomes as an end-year essay. So, Josh, thanks again for joining us.
Yeah, pleasure to be here.
So Josh is coming from Manhattan. Reason I mentioned that is he's in kind of the belly of the beast, so to speak, when it comes to the investment world. So anytime we have somebody like him drop by the office, it's a great opportunity for us. Obviously, we're talking about the market all day, every day. But to have somebody who's that close to it and that's all they look at and talk about all day, we learn a lot. So having him as a guest today, it's a great opportunity to bring some education to you guys. But just know that whenever we're acting as the subject matter expert, we have plenty of folks like Josh in the background that we're leaning on as the true subject matter expert to be able to give you the best thinking and the best options that are available out. So that's like a brief, like kind of interlude, so to speak. But Josh, maybe just spend a minute just briefly touching on your role in kind of Invesco as a firm.
Sure. Yeah, absolutely. So I think with Invesco, many clients know us for probably our QQQ ETF. Probably see it plastered all over the place, especially around March Madness. So outside of QQQ, though, we do have a very substantial asset management business. We're one of the largest asset managers in the world. Manage about $1.8 trillion across, both the U.S. and globally in terms of international. But really what I focus on is what we call our separately managed account business. So many folks might be familiar with mutual funds and ETFs, but really separately managed accounts, just think of that as almost like, us managing your own personal version of a fund. And so what my team does specifically is we seek to really deliver, in that wrapper, right? So manage these accounts for clients individually with both, thinking about, right, trying to get equity exposure that looks like a benchmark, but also proactive tax management on top of it, which is a huge benefit for so many clients. You mentioned coming from Manhattan, especially folks in high tax states and high tax areas like that, can add a lot of value.
Yeah, and it's a great point to make, right? Like taxes are relevant for anyone. Yeah. So if you have money in the market, obviously you should at least be paying attention to what are the tax implications associated with how you're invested, what's in your portfolio, right? And then you mentioned the topic, separately managed accounts. We've recorded other videos in the past educating you on what a separately managed account is. So if you're not familiar, by all means, feel free to reach out if you have questions. But that's what we're here to talk to you about today, right? Hey, everyone understands a lot of the basics. What is tax loss harvesting, right? So we can briefly touch on that. But what we're really here to drill into is for those folks who are looking to take it a step further, right? And why separately managed accounts are very relevant is for the end investor. You want that institutional level money management. You don't necessarily want the fees associated with something like a mutual fund when it comes to how that impacts your tax situation. But you're not there to look every day for tax loss harvesting opportunities as an end investor. So having a team like Josh's in the background, that's the power of a separately managed account, right?
Yep.
So kind of, I guess, taking it a step further, can you maybe just talk about kind of the evolution of tax management when it comes to tax loss harvesting versus direct indexing versus kind of
Yeah, absolutely. So, I think especially maybe just giving a little bit of historical context here might be helpful. So, when we think back maybe, 15, 20 years ago, many people, maybe their broker would invest in a handful of stocks for them, right? And at the end of the year, the client would call and say, hey, I've got these gains that I've realized over the course of the year. Can you just scan my portfolio? If there's anything at a loss, sell it. Right. Because we all know, right, some stocks go up in a year, some stocks go down. And so there's always going to be some winners and losers. And so, that was the process for a long time. And, again, that was helpful, at least to be able to do that. Fast forward, probably to about 10 years ago, maybe 5 to 7, when it really started to pick up is this concept of direct indexing. Right. So when I think of direct indexing, really what I think of is, again, a separately managed account. So, account that is in your name at the custodian, right? We are, as an investment manager, managing that account for you. So we actually get the information of, what stocks are at a gain, what stocks are at a loss, right? We're buying a bunch of stocks basically to give you exposure that looks similar to a benchmark, maybe like the S&P 500, but all the time, or, usually on a wash sale basis, which is like every 31 days or so, we are basically scanning the portfolio. We need to do this in a somewhat systematic way, right? Scanning the portfolio, looking for stocks that are at a loss, harvesting those, but redeploying those assets so that, again, you're still tracking that benchmark, roughly speaking. And again, that's a huge benefit, right? If we can do this more often than just at the end of the year on an ad hoc basis, you can constantly be generating those kind of tax benefits, if you will. Now, taking that a step further, in one of the strategies that we launched about 3 years ago, we call our enhanced tax optimized strategy. Really, that can help to even further extend the durability of that tax benefit. Because one of the kind of challenges, if you will, as I always like to put in air quotes, is, we're investing in U.S. equities for appreciation, yet at the same time, once the portfolio appreciates, you have less tax benefits that you can find, right? Because more of those stocks go up the price. And so, our enhanced strategy, what that seeks to do is it just has kind of a couple more components to the portfolio. And I always like to call it kind of like has stuff that zigs when everything else zags. And it gives us just more opportunity to try and find those tax benefits and also to have them on a much more durable basis than just maybe the first couple of years that you're investing like traditional direct indexing is offered.
Yeah, and that's a great moment to pause, right? Where you talk at a very high level, but make it very easy to understand. But maybe drilling home a few components of what was explained there to kind of simplify it for folks who might not be as kind of well-versed in these things, right? Yeah. To Josh's point, the opportunity for tax loss harvesting becomes smaller and smaller the longer you hold the portfolio. Because what Josh was explaining is there's only 500 securities in the S&P 500, right? How many of those are winners? How many of those are losers? Hopefully there's less losers than winners. That's what keeps the market going forward, right? And so as you run out of losers to tax loss harvest, that's what Josh is referring to. And that's the general idea of tax loss harvesting, and then how it's applied in direct indexing. Direct indexing is the tool or vehicle or lever, I would like to say in this context, where you're able to enhance the ability for those tax loss harvesting opportunities, right? And so the reason I reference it as a lever is it's an additional lever. And as you're mentioning, the long-short component was essentially what you're alluding to.
Yep.
That's effectively an additional layer or lever that you can apply.
Yeah, that's absolutely right. And I guess, just to explain that a little bit further, right, the way that our enhanced portfolio is structured, think of it as almost having that core of, again, those kind of stocks that we're owning to give you exposure like the S&P 500. But the difference with these accounts is that we actually enable margin, which basically allows you just to borrow against what you already own, right? It's, there's equity there. You have dollars that are yours. And so you can kind of borrow against what you fund the account with. And really what we're doing is we're putting just additional exposure around the portfolio. And what that basically allows us to do is we have extra what we call long positions. So think of those just as buying stocks like your Apples and Googles and Microsofts, right? But a little bit more of it. And what we're also doing is incorporating short positions into the mix. And those are really the pieces that I was mentioning, are the things that zig when everything else zags, right? For those not familiar with short positions, basically, you make money in a short position when the market goes down or the stock goes down, and you lose money when the stock goes up. And so, again, if we're thinking about things that our markets are appreciating over time, if we have short positions, right, we may be actually able to find a few of those losses if the market's going up. And that's what allows us to have that kind of durable tax benefit.
Right. And I guess one of the balancing acts here as an investment professional, someone who's recommending these strategies, someone who's educating clients on how they work, is there's multiple layers, right? And it can invite it can invite confusion, right? And so when people are confused about what's being educated, it almost forces them to think there must be a catch, right? Or there's something that, what should I be weary of, right? And in this context, when you're talking about the long short component, that's where a lot of the confusion gets brought in from the end investor, right?
Yep.
And it's our job as the advisor, it's your job as the portfolio manager to, one, educate, but two, simplify, right? And I think you did a great job when you were explaining it. But keeping things simple for you guys as the viewers, it's, to Josh's point, if you have the one position, it's on the same security, you have it in a long position and a short position, by nature, they go the exact opposite way.
Correct, yeah.
So whether the market's going up, whether the market's going down, this effectively gives us a tool to create those tax loss harvesting opportunities in any environment.
Yeah. And just to take that a step further, right, the reason that we also, though, are pairing those short positions with the extra long exposure is that generally that helps us just to when we're losing money here, we're making money here, and vice versa, right? So that's the real power of it, is that you don't have to take more general kind of risk. This is not inherently a more risky portfolio, right? It's giving us more opportunities to try and find those benefits. And, again, I'll reiterate the point that this product, it's seeking to basically give you something that looks, feels, acts like the S&P 500 in total. It just has that ability to generate those more durable tax benefits.
And that's a great segue to kind of the next component that I was going to mention as kind of that the area where confusion sets in, right? It's how are you able to track the underlier, right? The index. And in this example, the S&P 500. And the net result for the end client is we're creating unrealized losses for you to then offset future dates, right? And so that's, again, it's the hardest piece for the end investor to really grasp in their mind is, wait, I had the performance of the S&P, but then on my statement, I had X amount of unrealized losses. How was my portfolio up X percent this year, but I was still able to generate losses? And you just explained it, but that's the piece when prior to the client seeing their own statement, they can't put that together.
I know. Yeah. And it's, look, like I'll be the first one to admit, as we were talking about the evolution of this tax management, right? There's more moving pieces to these portfolios for sure. And when you look at the statement, right, there's kind of more positions. They're kind of looking different than maybe what you've seen historically. But again, I think that really what it comes down to is kind of like the grass tax of what you actually get when you invest in this portfolio, right? And, number one, it's something that in aggregate of all of those kind of line items that you see on the account, right, it's going to be something that looks, feels, and acts like the S&P 500. Of course, there's going to be some risk around it, and we need that risk to find, these kind of tax risk benefits for us. But overall, it's going to give you something that in aggregate looks like that, but again, has this opportunity to harvest losses, it's durable losses. And, again, I probably point to some of our live track record to show, that we have been able to do this, right? Our live track record shows for over 3 years in aggregate, we have been able to, in these accounts, track pretty darn closely to the S&P 500, again, with that wiggle room, but at the same time generate substantial tax benefits on our longest running account. I mean, it was funded with $1 million in cash, and after 3 years, it's tracked the S&P 500, and it's actually gone up in value in aggregate, but actually has harvested over $500,000 of realized losses. And that's, a real track record, a real SMA is just able to not only give you something that you need, which is for equity, right, and that U.S. large cap equity exposure, but also these big cap benefits.
Yeah, great example. And again, in loose example terms, you start out with $1 million account value. 3 years later, you had roughly 50% of that starting account value of banked losses, effectively, right? So the piece that I was trying to drill on as well is like the tracking error component, right? Where keeping things simple, if you've ever taken any form of a statistics class, it's effectively how close are you tracking that underlying index, right? So you just maybe talk about how that plays into effect.
Yeah, no, great question. So, when we talk about our strategy, number one, if you fund it with cash, and maybe we can talk in a couple minutes about different ways that you can fund this, because that's another really big benefit of this strategy is it doesn't need to be just cash. But if you think about just funding this again in that example with $1 million of cash, right, what we're trying to do is basically put together a portfolio that gets you to what we call a 1% tracking error to the benchmark, right, or to the S&P 500. And so what that means, to your point, is, generally 2/3 of the time, our portfolio in terms of the performance, the actual performance, should be plus or minus 1% of the S&P 500. So if the S&P 5 is up 25% a year, that means we could be up 26 or up 24, but we're going to be pretty close, right? It also means that, there's the other side is 1/3 of the time it could be outside of that, right? So again, we need this wiggle room to be able to, manage all of these pieces together and find the most optimal portfolio. But at the same time, we are trying to deliver something that is still going to give you something that looks, feels, and acts generally like that benchmark.
Yeah, and all really important components of, like, again, the education part, right? Where we don't expect you guys to leave this video and know all there is to know about direct indexing or any type of long-short strategy, but it's a good example. These are the types of questions that come up. We're taking the time to educate the client. But it's important to know that these such things exist out there, and not all advisors are having these conversations. And not all advisors have access to platforms and institutions like Invesco, and it's why it's important to have that access. You brought up one thing that's really important to bring up is examples of, hey, who is this applicable to? Or you mentioned you don't need to fund the account with cash.
Yep.
I think it's a great segue into like the most common examples of people who are using these strategies. And I would venture to say it's less often people funding it with cash, more often people funding it with appreciated assets or a stock portfolio that they need to unwind out of.
Yeah,
mind maybe going to some of those examples.
Yeah, absolutely. So, and you're right. I mean, when we look generally at the accounts that we have, all of our accounts, and there's a lot of them, a minority is cash funded, right? I would probably say 10 to 15% of our total assets in this strategy are cash funded. So there is certainly a use case for funding this with cash. And, a lot of times when we think about folks who fund this with cash, it's going to be more of like I'm selling a business, I'm selling a piece of real estate, I have a opportunity zone capital gain coming up, I have a capital gain from anything really, right? And so using this almost as, hey, again, core U.S. equity exposure where you're still getting the returns similar to the benchmark, but with this more kind of substantial loss harvesting capability, right? You can use those losses or bank them ahead of time in expectation that you have that capital gain coming up, and this helps you to kind of defer and defray some of that capital gain tax, right? So there's definitely a use case there, but it's a little bit less frequent than, to your point, funding this with appreciated or concentrated stock positions. We see a lot of that, right? And I mean, the sheer performance of the markets over the last, 5 to 10 years, candidly, has left a lot of people with these, concentrated stock positions. It could be from employment. Maybe they just, made a little investment 10 years ago that now is a big investment just because of the performance of some of these stocks. And so, you kind of feel stuck in those situations, right? Where, you now have this stock. Maybe it's gotten a lot more volatile. Maybe you just can't take that anymore and don't have the appetite for that risk. The beauty of, again, what we can do in this portfolio is you can fund it with that stock. And again, I mentioned kind of like borrowing against the equity that you kind of fund the account with. We can actually borrow against the equity that's in that position to, again, create that additional exposure. And think about it this way, let's just say it's any of the Mag 7 stocks. I put $1 million in there. I'm now able to get an additional $300,000 of long exposure. So new stocks that I'm able to build around $300,000 of those short positions. And again, oddly enough, it actually helps to diversify that position immediately. So you get a little bit of a diversification benefit up front. But then what we're doing is really trying to find any losses that we can in the portfolio and use that to slowly morph and whittle down that original position and get it towards a diversified portfolio. So, again, I think that is really one of the most powerful use cases. I like to say, look, it doesn't happen overnight. This is not like a, immediate type of you're selling that stock off, immediately. It happens and it morphs the portfolio. So you have to have a long-term view of it. But at the same time, again, I think for so many clients who feel stuck and feel like they haven't had a great kind of option, I think that this can be a very valuable tool to help to kind of get to a more diversified portfolio over time.
The reason I know you talk about this every day is every time I'm in my mind or mid-statement, I'm thinking about where I'll interject with a thoughtful piece. You like drop it right after I come up with a thought. So I really appreciate that part. Yeah. But in the examples, driving it home, make it more real for people. Yeah. The most common example you just provided was a tax transition is the easiest way to summarize it, right? Like however you have accumulated that stock that's appreciated, whether it's a concentrated single stock, a few stocks, or it's just a portfolio that you've had for a long period of time, and it might be diversified, but the unrealized gains that are built up because it had never been actively tax managed could be substantial.
Yep.
Right. So a tax transition doesn't have to be that scenario where it's a single security or a concentrated portfolio. So we see all the time somebody come to us with $2-3 million or $1 million or more, and there was no proactive tax management being done.
Yep.
And so these unrealized gains accumulate. The portfolio is diversified, but they still have the same issue that example you, right? The other piece is like larger liquidity events. So like a real estate investor, a business owner, an executive receiving compensation in the form of equity or stock. All examples of these are liquidity events are on the horizon. You might not know if it's 3 years, 5 years, or 18 months. But as your planner, this is a tool where we can proactively start banking losses to offset those future gains. So it doesn't have to be something inside your portfolio that we're working to offset. It could be an asset. It could be a liquidity event, an inheritance. All things are examples, right?
Yep. Yeah, absolutely.
And so those were some of the things like brainstorming prior to the recording. Those are real life examples we're working through for clients right now, right? An executive who has stock compensation that's coming due in a year or two, business owners looking to sell their business. But real estate investors is the one area that I've been focusing recently because I feel like it's such an underserved market from a traditional financial planning perspective.
Yeah.
And I feel like it's constantly a game of kicking the tax burden down the road, which is the case for a lot of investors, right? For people who aren't focusing on the traditional markets as much, they kick the can. Now they're retirement age. And it's like, all right, well, I need money to live.
Yeah.
So how are you going to create that income without triggering a bunch of taxes for yourself?
Right. Yeah. It's a great point. And I mean, I feel like that could be another one of those situations where a cash funded account might make sense, right? So, you could use some cash to fund this account. Again, it's giving you that for equity exposure, which is great. Most clients want to have some U.S. equity exposure. But like if it's constantly kind of generating these tax losses, you can start to kind of peel parts of that real estate portfolio off, or maybe you let it generate enough where, if you own properties, you then get to a point where, okay, I can sell this one property and I at least can manage that tax burden, right? And so being able to almost have this seesaw of, the tax kind of losses over here to offset the taxable gains that I'm expecting over here, right? That can really help. And, again, we talk about this with investment portfolios too, right? Folks who, are getting towards retirement, they're starting to try to think, hey, how do I start to wind down some of my taxable investments, right? You're generally going to have gains that you're going to need to start peeling off. And so having something that can help you to manage all that tax burden, whether it's real estate, whether it's your taxable investment portfolio, or anything else that is going to be generating capital gains, it can be super, super valuable.
Yeah. And to your point, like, you can't just sit there and do nothing, or you're going to have to deal with the consequence risk if you do, right? And this is a tool or a strategy that allows you to be proactive. More than anything is the point to drive home there. Was there any components of the strategy or conceptually do you think are important to drive home? Anything we missed?
No, I mean, I guess the last thing that I would just say is, there are, like I said, there's definitely a little bit more moving pieces to these portfolios. One of the things that also I think has really made these portfolios even more attractive to run is that in many instances we can actually, and firms like yours can access really advantageous financing. So I mentioned kind of like that borrowing piece. We all know when we borrow money, we have to pay for borrowing, right? But many of the kind of core custodians that I know Secure Planning has access to, right, have started to see, this is a big opportunity. And so, that financing piece that many people might think could be a really expensive proposition actually has gotten so much more attractive, and in recent history, really attractive, so much so that the total all-in cost of running this portfolio, even with that piece, could be very advantageous, especially if you think about, again, that long-term benefit for any of those investors, those situations that we just talked about. It can be, like the cost that you're paying relative to the benefit that you're getting is just, the benefit is so astronomically higher than that cost that I think it is important. But, again, I do just always like to put it out there, right? As you think about the evolution of different types of products and ETFs of direct indexing and, what we call our enhanced kind of tax optimized equity SMA, right? Like all of them have different cost structures. But again, this one, I think it can be still very cost advantageous while at the same time generating these big benefits for you. So that's the last thing that I think is really worth just reiterating that point.
Yeah. And as the investment professional who's working with the end client, it's like, that's really our job too. It's like most times clients just look straight at the end line, right? Like, how much does it cost? What are the returns, right? And it's like, obviously both very important components. But to your point, if we're presenting something that has a cost associated with it, it's our job to educate you, hey, here's what you're paying for and why. But to your point, if the benefit far outweighs what you're paying for it, and we're able to illustrate that with real results, then that's all that matters to us as the advisor is, hey, as a fiduciary, this is a better result for you, and we can show you with confidence because this is a proven strategy, right? Yep. And then to your point, like, I didn't know if this is what you were alluding to when you said financing, but with the real estate investor or business owner, the ability to be able to lend against your portfolio is kind of that other piece, right? Where don't want to necessarily go too far down that road, but the reason I bring up business owners and real estate investors is, again, like underserved when it comes to traditional markets because they're so good at earning on their own investments, right? Mm-hmm. So that's the kind of that added piece that I've been talking about with some folks in my world is if we can help you offset a future tax liability, grow a portfolio of assets for you that tracks the underlying index, which if you're going to be invested in the S&P anyway, why not do it in a tax advantage basis, right? But also being able to lend against your portfolio, right, as a source of liquidity for different investments, right? So again, not to go down that rabbit hole too much, but it goes back to the levers, right? Like it just gives you additional levers to be able to deploy. Yeah, you're spot on. So again, I really do appreciate you, Josh, taking the time, and I hope this was helpful. And I know certain things might get into the weeds, as they say, that's what we're here for. If you have questions about anything we talked about, feel free to reach out. Feel free to leave a comment. But we have access to the experts like Josh, and we leverage them every day.
Nice on that, Josh. Yeah, thanks for the time.